Welcome to Validea University. In this series of short videos, we will discuss some key investing concepts that impact investors today and distill them down into their most important components. In today's video, we will look at value traps and methods to help avoid them. Value investing is full of pitfalls. It is easy to think that as a value investor, all you need to do is buy cheap stocks and eventually the market will come around to your way of thinking. But that just isn't the way things work in the real world. Many value stocks are cheap because they deserve to be. Some of them no longer have sustainable businesses, and as a result, their current discounted multiple will look really expensive relative to where the business is headed. These types of stocks are often referred to as value traps, and value investors do everything they can to avoid them. There are two major things to keep in mind when trying to avoid value traps. The first is that they're part of value investing. When you buy a basket of cheap stocks, some of them will be cheap for a reason, and some should be even cheaper than they are. Although value traps may be able to be minimized, they're an inevitable part of the value strategy. The second is that many of the methods an investor can use to circumvent them will also result in avoiding other stocks that will end up being good investments. The balance between avoiding the bad stocks while not avoiding the good ones is an incredibly difficult one, and even the best investors and factor-based systems struggle with it. Here are some things to look out for to help avoid value traps. The first is projected future earnings and sales that are well below the past. By definition, a value trap is a stock that is cheap, but it is also cheap for a reason. One of the major times past data can fool you is when the market knows something significant has changed for a company, but the past fundamentals don't yet reflect it. For example, if oil prices fall rapidly, oil stocks will look very attractive, but if future earnings are expected to be cut in half, those valuations don't paint a realistic picture. We have found that by looking for major differences between past and future sales and earnings, we can help limit exposure to these types of value traps. The one caveat with this is that the only way to do it is to use analyst estimates, and they are notoriously inaccurate. But we are only looking for major deviations, which doesn't require a high degree of precision. The second is big differences between operating cash flows and earnings. If cash flows are lagging well behind earnings on a consistent basis, it is typically a sign that earnings are inflated in some way. We have found that excluding companies where these differences are most extreme can help to limit value traps. The third is very high levels of debt. Debt magnifies problems. Value stocks typically have some level of distress, and firms with a lot of debt in their balance sheets typically have much shorter runways to deal with their issues, and much higher chances of bankruptcy. Significant debt isn't a guarantee of failure, but it also increases the odds. We have found excluding firms with extreme levels of debt helps to avoid value traps. The final one is very low relative strength and high short interest. I group these two together because they both get at the same issue. The market is right more often than it is wrong, and the stocks at the absolute bottom of the market in terms of relative strength tend to have greater problems than their valuations would indicate. The first three criteria we discussed got at specific fundamental issues that can lead companies to become value trap. This criteria just recognizes that we will never be able to identify every fundamental issue, so we try to uncover the others by excluding stocks with the absolute worst relative performance. High short interest is a different way to get at the same thing. Short selling is one of the toughest things to do in the market since the market goes up much more than it goes down. It's like trying to paddle a boat upstream against a river with strong current. Since only the best short sellers will survive, it's often not a good idea to bet on the stocks they are betting against. In the end, the most important thing to know about avoiding value traps is you can't do it completely. The second most important thing to know is that any attempt to do it will have unintended consequences. If you are a value investor, you're going to invest in some value traps. But if your goal is to limit them as much as possible while trying to avoid unintended consequences, we have found common sense criteria can be helpful in doing that. This concludes our look at avoiding value traps. We appreciate you taking the time to watch the video. To find more of our Validea University videos, you can follow our Validea channel on YouTube. You can also follow us on Twitter at @GuruInvestor. To read our investment commentary, you can go to our blog at blog.validea.com. To take a free trial to our subscription product, which includes the 22+ factor models we run, you can go to our research website at www.validea.com. Thank you for watching.